There's an old rule among people who've traded precious metals for decades. Whenever a story about gold sounds too perfectly timed to a calendar date, slow down before you believe it. Right now, two completely opposite stories about gold are circulating at the same time. One says the government is about to reprice gold to $10,000 an ounce this summer, triggering the greatest wealth transfer in a generation. The other says gold has already peaked, and the recent pullback is the beginning of a much longer, painful slide. Both stories can't be true. And here's the uncomfortable part: most people watching either story aren't actually evaluating evidence. They're pattern matching to whichever version makes them feel something, excitement or dread, and then calling that feeling research. Today we're not going to tell you which story to believe. We're going to give you something far more valuable, a simple, permanent way to test any financial rumor yourself for the rest of your life. We'll use this gold story as our example, but the method works on absolutely anything you hear about money. And by the end, you'll understand not just what's really happening with gold right now, but why the loudest story is rarely the truest one. Every few months, a new financial rumor sweeps through the internet with the same shape. It starts with a real, verifiable fact. Then it gets stretched, just slightly, into something far more dramatic. And by the time it reaches you, it's wearing a costume of certainty it never actually earned. The gold repricing story is a perfect specimen of this pattern because the seed of truth inside it is genuinely real. There is an actual economist, a respected one, who has proposed a legitimate financial instrument tied to gold. There is a real, decades-old accounting oddity where the government still values its gold reserves at a fraction of the current market price. Both of those things are true and checkable. What's not true, or at least not supported by any real evidence, is the leap from an interesting proposal exists to the government will reprice gold to $10,000 this specific summer. That leap is where rumor turns into performance. The most convincing financial myths are almost always built this way. Mostly fact, with just enough exaggeration stitched on top to make the fact irresistible. Which is exactly why you need a filter, not intuition, not vibes, an actual, repeatable filter you can run any claim through in under a minute. Let's start with what's actually real in this story, because understanding it properly is the only way to spot where it gets twisted. There's a genuine proposal from a credentialed economist who was once nominated for a role at the Federal Reserve for something you might call a gold-linked government bond. In plain terms, you'd lend the government money today, and decades later, you'd have the choice to be repaid either in dollars or in an equivalent value of gold. It's a real idea. It's been discussed in serious policy circles. Think of it the way you'd think of a farmer offering to repay a loan, either in cash or in a share of next year's harvest, a genuine hedge against the value of money changing over time. Separately, there's a real accounting quirk that has nothing to do with that proposal but gets tangled up with it anyway. The United States holds an enormous reserve of physical gold, the largest sovereign holding in the world. But on the government's official books, that gold is still valued using a price set decades ago, a fraction of what gold actually trades for today. It's a bit like a family, still listing their grandmother's house on their net worth statement at the price she paid for it in the 1960s, even though the neighborhood has been rebuilt around it since. Both facts are true. Neither one on its own implies an imminent, dramatic revaluation timed to a national anniversary. But put them side by side, add a specific date, and suddenly you have a story that feels inevitable, even though nothing about the mechanics actually supports that timeline. Here's the filter, passed down from people who spend their careers inside institutions where emotional reactions to headlines simply aren't tolerated. Question 1. Who benefits if I believe this? Every loud financial claim has a storyteller, and storytellers usually have an interest. Someone insisting you must buy a specific asset immediately, urgently, before it's too late. Check what they sell. It doesn't make them wrong automatically, but it changes how much weight their urgency deserves. Question 2. What is serious money actually doing? Not what people are saying on camera. What large, sophisticated pools of capital are actually doing with real money. If institutions genuinely believed a specific asset was about to triple within weeks, you wouldn't need to be told about it. You'd see it in trading volume, in positioning, in quiet accumulation, happening well before any announcement. Money tends to move before mouths do, because money doesn't benefit from telling you its secrets in advance. Question 3. Is this a fact or a feeling? This asset is going to multiply overnight, is a feeling wearing a suit. A specific institution purchased a specific verifiable quantity of an asset last month is a fact. Facts can be checked against public records. Feelings can only be repeated more loudly. Build your decisions on the first category. Enjoy the second category as entertainment, the way you'd enjoy a dramatic movie trailer without mistaking it for a documentary. Run any claim through those three questions, and something remarkable happens. Most rumors quietly fail before you've even finished evaluating them. So let's actually run the gold repricing rumor through the filter, honestly, the way you would in a room full of skeptical colleagues. Who benefits if you believe gold is about to leap to $10,000 this summer? A meaningful share of the loudest voices spreading that story have some connection to selling gold, gold coins, or gold-adjacent products. That doesn't make the underlying economics fake, but it does mean urgency is doing some of the persuading, and urgency should always be treated with suspicion in financial claims. What is serious money actually doing? Looking at recent trading behavior in the gold market, there's no unusual surge in buying volume accompanying this story. No sign of large coordinated accumulation ahead of some anticipated announcement. If institutional investors genuinely expected an imminent official revaluation, their trading behavior would very likely show it, quietly, before the public story ever caught fire. It doesn't. Is this a fact or a feeling? A government formally revaluing its gold reserves isn't something that happens with a press release on a convenient anniversary. It requires legislative and regulatory coordination across multiple institutions, and it carries a real diplomatic cost. It can look to the rest of the world like a government quietly admitting it doesn't fully trust its own currency. That's a decision serious policymakers approach very cautiously, not one they schedule around a national holiday for symbolic effect. 3 questions, 3 reasons for real skepticism. The specific dramatic version of this story, gold to $10,000 this particular summer, tied to a symbolic date, does not hold up well under the filter. This isn't the first time a mostly true fact has been inflated into an irresistible financial legend, and it's worth remembering one particularly instructive case. During periods of geopolitical tension throughout history, rumors about sudden currency revaluations or dramatic gold repricing have circulated repeatedly, often with a real kernel of policy discussion buried somewhere inside them. In almost every documented instance, the actual outcome looked nothing like the dramatic version that spread furthest and fastest. What typically happened instead was slow, procedural, unglamorous change, the kind that never trends on its own, because gradual is bad for engagement. The lesson isn't that dramatic financial shifts never happen. Occasionally they genuinely do. Currencies get devalued. Systems do get restructured. The lesson is that when they happen, they rarely arrive as neatly as the rumor promised, on the date the rumor promised, for the dramatic reason the rumor promised. Real structural change in money tends to be a slow tide, not a single dramatic wave arriving exactly on schedule. Here's where it gets genuinely interesting though. Because dismissing the exaggerated version of a story doesn't mean dismissing the underlying asset entirely. That's a mistake plenty of people make, swinging from believing every rumor to disbelieving everything connected to it. Some experienced investors look at gold's recent pullback and see exactly what you'd expect after any strong rally, a healthy, ordinary correction, not evidence the story is broken. Assets that climb sharply because of enthusiasm eventually shed some of that enthusiasm-driven buying. That's not collapse, that's gravity. Others point to something the rumor entirely skipped over because it's less thrilling than a dramatic prediction. Central banks around the world have genuinely, verifiably been accumulating gold at a pace well above historical norms, and a meaningful portion of that buying happens quietly, through intermediaries, without public announcement. Following a major conflict where a government's foreign currency reserves were abruptly frozen by other nations, a number of countries drew the same uncomfortable conclusion: reserves held in someone else's currency can potentially be frozen by that someone. Gold, physically held, carries no such vulnerability. The important lesson, the exciting rumor, and the boring underlying trend are 2 entirely different things. You can correctly reject the first while still taking the second seriously. In fact, that's precisely what a disciplined investor does, separates the noise from the signal instead of throwing both away together. So how does this translate into an actual, calm plan? The first principle is removing emotion from the decision entirely, because emotion is consistently the most expensive thing in any portfolio. Fear sells at the bottom, greed buys at the top. Nearly everyone is vulnerable to both, and the entire purpose of a written plan is to make your decisions boring on purpose. Picture your finances as a house with 3 distinct sections. The first section is the foundation, money you genuinely cannot afford to lose. 3 to 6 months of essential living expenses, kept somewhere safe and boring, like a high-yield savings account. This section isn't meant to grow. It's meant to simply exist, solidly, so nothing else in the house can collapse the whole structure. The second section is where wealth actually gets built over decades, a diversified mix of stocks and index funds held patiently through market cycles, adjusted gradually as circumstances change. This is where compounding does its quiet, unglamorous work over long stretches of time. The third section is protection, a modest allocation to assets like gold or silver, held not to make you rich quickly, but to hold their value when other parts of the house are under stress. Most thoughtful frameworks suggest somewhere in the range of 5 to 15% of total wealth for this section, adjusted based on your own comfort with uncertainty. Nobody installs a smoke detector because they're hoping for a fire. They install it because fires occasionally happen, and the cost of being unprepared is severe. On the specific question of timing, trying to identify the exact bottom before buying is a losing game, because nobody reliably knows they've found the bottom until long after it's passed. A steadier approach is spreading purchases out gradually over time, accepting an average price rather than gambling on a perfect one. It feels less thrilling. It performs better historically for most people, most of the time. Here's what decades of watching financial rumors rise and fall eventually teaches you. The loudest story is almost never the most accurate one, because accuracy doesn't generate urgency, and urgency is what spreads. The quiet, unglamorous trend, carefully verified, checked against real behavior rather than real excitement, is usually where the actual truth is sitting the whole time, patiently, waiting for someone calm enough to notice it. You don't need to be the smartest person watching a financial story unfold. You just need to be the most patient one, willing to ask 3 unglamorous questions before you let a headline touch your money. The market, and the rumor mill that surrounds it, will always reward those who separate genuine signal from performed urgency far more generously than it rewards those who simply react the fastest. Let's bring this together. A real economic proposal and a real accounting quirk got stitched into a story about gold reaching $10,000 this summer. When you run that story through 3 simple questions, who benefits, what is money actually doing, is this fact or feeling, it falls apart fairly quickly. But underneath the exaggerated headline, there's a genuine, boring, verifiable trend of central banks quietly accumulating gold as insurance against a world where currency reserves can suddenly be frozen. The lesson isn't ignore gold, or believe every rumor, or distrust every rumor. It's simpler than that. Learn to separate the fact from the performance. Build your portfolio like a house with a solid foundation, a wealth-building floor, and a modest layer of protection. And give yourself permission to be calm, even boring, while everyone else is reacting to whatever story is loudest this week. The market has always rewarded patience and quiet verification far more reliably than it rewards excitement. If lessons like this help you think a little more clearly about your money, you know where to find us. Subscribe to Grandpa's Finance Class. We'll keep sitting with these ideas together, one calm lesson at a time. We'll see you in the next one.